Good morning, everyone. Thank you so much for joining our Phillip Security Research 11 o'clock Monday morning briefing. So last Saturday, we actually have our Singapore and US third quarter 25 strategy and stock pick event. So today we will be going through a little bit of summary of it and also our usual technical polls. And for disclaimer, please note that the information provided in this seminar is solely for educational purpose and shouldn't be considered as a financial advice. So please seek any advice from a financial advisor before you actually make any investment decision. So next, I'll pass the time to Glenn.
Thanks, Serena. Yep, so for our, we're just doing a quick recap of what we went through on Saturday for those who have joined us. It's our third quarter 2025 strategy and stock picks, and I guess the US outlook for the tech sector. So this picture here is just depicting, all the tech companies represented by the phone, and you can see the headphones, trying to go on a bull run, but you can see that Trump there at the back, on the ground is trying to chase them. Is trying to stop them from going on this bull run, with a lot of things like his tariffs, and his threatening to impose tariffs on Apple, especially, and on Nvidia also blocking all the sales of the chips to China. Yeah, so this is basically what it represents. Moving on to the next slide. Yep. Next slide, please. Thank you. Yeah, so we'll just be going through the different teams for the Max 7. So all of them have their, I guess, in a different sector, or there are also some sectors that they do share, like mainly I think it's the cloud sector that three of the companies do share. But we'll just be going briefly, describing each of the sector and what we feel the outlook would be like, and as well as how the company will be affected, and how will we see the future for the company, at least for the next quarter and for the rest of the year. So I'll be starting firstly with the auto, and mainly the EVs industry, because Tesla is part of the Max 7 and is the largest player in the US for the EVs, and still the largest player as of now. Yeah, so the main thing is whether or not the EVs can continue to take market share from the traditional ICE vehicles. Yeah. Next slide. Yeah, so in the US, the Tesla sales have disappointed. We have seen, that the overall the EV market has actually grown in the US for Tesla, right? It grew by 11% year on year. So it just shows that the EV market is still continuing to take market share away from some of the traditional ICE players. But then again, Tesla's growth has declined. So they are losing market share in their main market, which is the US. A lot of different reasons and factors for this. I think partly due to the political reasons, because Elon Musk was tied very closely to Donald Trump at that point in time, and then he joined the Doge to cut the government costs, right? So a lot of their consumers, maybe they were more liberal, so they refused to align with Elon and, in part align with Tesla. So a lot of them held back on buying Tesla cars. Also, the fact that they had some disruptions to their production line because they were doing an update to their Model Y. So all of their factories were affected by this, so they had to slow down production. And in a sense, if your production slows down, deliveries will also slow down. Yeah, so that's the main reasons why we believe they slowed down in the first quarter of 2025. Moving on to the next slide. Yeah, in China, so yeah, this chart just shows the market share of both US and China. I already did the US part, why we believe that market share. And we can see in the blue line here that the market share is continuing to decline. In China, it's a similar story where they're also losing market share, but maybe for different reasons. I guess the political one is quite the same, but I think the main reason why they're losing market share in China is really due to the competition, especially in the Chinese EV players. So BYD hasn't really lost much market share. They're still continuing to grow and take market share away from Tesla. And also, the other players that are coming up, like Xiaomi is now quite big in China. NIO is also up and coming. But a lot of small players are it is hurting, I guess not just Tesla, but the larger players as well. So moving forward, we believe that, Tesla in China at least, we believe that there will be some form of consolidation where a lot of the small players will start to die off because, they don't have the economies of scale. They're unable to compete on the price level, right? So the larger ones will just, in essence, in a few years' time, we might see them take over the whole market, and that's where we'll just have left with like a handful of the big players, mainly BYD, Tesla, Xiaomi and NIO and a few others. Yeah. So, but for Tesla, it's a bit it's not so bright, right? The outlook, because they have to keep contracting their margins because they have to compete on the price with the Chinese EV players, as well as in Europe, in China. In US, they are losing to the Japanese as well as the homegrown US players like Ford. And also, Elon Musk coming back could be one of the turning points for them, where he could possibly try to turn them over and turn the tide. The other two outlook that we are seeing for the rest of the year that could turn it for Tesla, first one would be the Model Y sales. So that's what they were saying previously, where because of this slowdown in production and people were holding off from buying the new cars because of the new Model Y, they're waiting for it, like how you would wait for a new iPhone. Yeah, so that's what slowed down production. We will only be able to tell in maybe the third quarter deliveries to see if there was any improvement. And then the last point, which is I think the most important one, would be their robo-taxi. They did launch in Austin, Texas in June, I think about a week or a few days ago. And it was mixed. The reviews were quite mixed, right? Some positive ones, but the negative ones were really blasting the whole robo-taxi, where they did a lot of mistakes. They weren't able to drive properly. They did some wrong turns, even just brake suddenly. Yeah, so there was some quite negative feedback on reviews on the robo-taxi launch. And it's rather small, right? They only had 10 or 20 cars in a geo-fenced area. So if they can't get that right now, where their competitors like Waymo has really launched it out, for public use and really charging customers. Yeah, and Tesla is still trying to play catch up. That's why we feel that there's a lot of headwinds for Tesla. We do have a sell call as well as a target price of $200 for the company. So that's all for the EV and Tesla. So I'll hand it over to Iqban, I think, for the semicons and NVIDIA. Thanks.
Thanks, Glenn. Yeah, I'll talk about the semicon sector. Next slide, please. Yep. We are seeing an overall upward trend in AI demand because and this is also driven by DeepSeek's emergence, because as mentioned by TSMC in their earnings call itself, DeepSeek actually lowers the cost of running AI models. So a lot of smaller enterprises can actually join in this industry and run AI models by themselves. Yeah. So apart from that, for the hyperscalers investments, they have been guiding higher capex for 2025 itself. And we estimate about 50% of these capex will actually go into buying GPU racks as well as networking equipment being used in data centers. So this will benefit companies like Broadcom, which supplies Ethernet switches to boost networking within the data center itself, as well as memory companies like Micron, as well as SK Hynix. And of course, not to mention the direct beneficiary of this increased hyperscalers capex is also companies like NVIDIA and AMD, which supplies GPU racks. Yeah. Next slide, please. Yeah. So for NVIDIA itself, in their most recent earnings, their China segment took a hit because the US export controls actually banned the sale of H20 chips to China itself. However, NVIDIA has still provided very positive guidance in spite of this. They are still guiding a 50% year-on-year increase. And this is being driven by Blackwell's continued ramp, as well as the outperformance in their gaming segment, which makes up about 10% of their revenue. Yeah, so for gaming segment wise, they recently launched their GeForce RTX 50 series, which is able to double the performance of latency as well as frame rate for gamers. Yeah, so this GeForce RTX 50 series is being built on Blackwell's ecosystem, and this improves the performance of inferencing to and And all these AI PCs can also be used be very suited to run AI models as well. And we do see an potential increase in PC sales as an industry, which will likely to benefit NVIDIA as well. Yeah, so a thematic occurrence happening at the later stage of 2025 is that the Windows 10 will Microsoft will cease to end support for Windows 10 itself. So we do see that over the coming months, I guess in 2026 itself, enterprises will switch up their very old PCs into newer AI PCs with stronger memory as well as um, DRAM DRAM memory as well as inferencing power so as to run the AI models as yeah. And another thematic thing that will affect NVIDIA is the removal of the AI diffusion rule. So this is being done by Donald Trump. Previously, before Biden left, he introduced this AI diffusion rule to split the global countries into 3 different tiers, and companies in the middle tier is unable to. There is a cap on them on how many GPU chips they can import. So with the removal of this AI diffusion rule, there is no limit into how many chips a country can import from NVIDIA itself. And why did Donald Trump remove this rule? We think that this is because he wants to use it as a bargaining chip for sovereign countries like Saudi Arabia and UAE, because as we know, they have massive investments into NVIDIA itself, and putting a cap on them will just limit the amount of potential which American companies can benefit from these sovereign countries' investments itself. Yeah, so going forward, this will very much benefit NVIDIA because more sovereign countries can invest into NVIDIA's chips itself. And we do think that another reason why we do think that Donald Trump removed this rule is because having more sovereign countries being involved to run their AI models on NVIDIA's chips, this will directly benefit American semiconductor chips like NVIDIA and AMD because they have a much bigger sample size as well as a bigger pool of developers working on their AI ecosystem. Yeah, so we do think that this is why they removed their AI diffusion rule, and going forward, we think it's very, very beneficial for companies like NVIDIA and AMD. Yeah. I think that's all from my end. I'll hand over the time now to Fahmi. Thanks.
Hi, thank you, Ben. So moving on to the next presentation is on software and cloud, which we think cloud growth is going steady. So next slide, please. So this slide is on the public cloud, right? So first on some definition is that public cloud is when a company delivers its product or services over the internet using shared cloud infrastructure. For example, some companies that we all know are Zoom that sells video conferencing as a cloud services. And also Adobe offers cloud-based tools like Photoshop, Illustrator through their Adobe Creative Cloud. So we are seeing more generalization of these cloud services nowadays. These services are usually sold as subscription, which they pay monthly or yearly to use computing power, so storage or software. Because of this model, cloud companies earn recurring revenue, which means more stable income and predictable growth over time. So from the chart, if you look at it, right, so we could see that the public cloud revenue companies have grown really well over the past years and are expected to grow at a double-digit CAGR of 70% until a projected year of 2027. So we think that the trend we are seeing right now is that public cloud is surging on the back of enterprises' demand. Public cloud services is projected to reach 966 billion in 2025, which is a significant increase from previously projected 600 billion expected in 2024. We think the growth currently and in the next few quarters would be driven by the increasing enterprises' demand. So enterprise use public cloud to save costs firstly, because companies don't need to buy expensive servers or data centers or even have premises data centers or super computing like super advanced. Instead, they can only pay for what they use, like when you pay for utility bills, right? So you only pay for what you use. They also offer flexibility and scalability these cloud services to the companies, meaning business can quickly scale up or scale down based on demand, meaning like no need to plan months ahead, right? So other reason of this growth are companies are changing how they work to stay competitive by using more digital AI tools. We think that the adoption of AI technologies is accelerating the role of cloud in business operation and outcomes. One example is a product offered by the Microsoft called Microsoft Copilot, right? So it is embedded with the generative AI through the cloud. So Microsoft Copilot is the generative AI tool built into Microsoft products like Word, Excel, Outlook, and Teams, products that are used by many companies throughout the world. So it helps users write, summarize, analyze, and create content directly within the application that they already use, just by inserting prompt instruction in the seconds. AI will do that for them. So which is very attractive to these companies. So next slide, please. Next is on Microsoft, right? So we think that Microsoft is on cloud-powered growth. So we expect Microsoft to continue performing strongly, which is to be driven by two main growth engines. As usual, first is its cloud services, which is Microsoft Azure. So, and the second one is its productivity software business line, which is Microsoft 365, right? So while the first key growth driver is Microsoft Azure, of course. Azure is Microsoft public cloud services that offer computing services, storage, AI tools, and more. Business use Azure to run applications, which Microsoft offer a lot of application to their cloud computing, which business normally would choose which one is suitable for them. It also helps to store data, power AI features without building their own system. So Azure is a major revenue stream, right, with continued demand from both large enterprises and SMEs, especially those adopting AI. I think Azure make up about, I think around roughly 40% of the Microsoft revenue. So if you look at the chart, we see that Microsoft Azure managed to retain a massive growth, right? So like you look at the bar, it's growing at 30% year over year, which is in billion, even in billions right now. The revenue is in billions. The Microsoft is still guiding approximately 30% year over year growth over the next few quarters, which is still confidence to the investors. So, and we think that they managed to keep this recently, right, because of their also AI integration to their cloud services. You can see from the chart that their AI contribution, which is highlighted in the orange line, is trending upward, which from single digit in the last 2 years back, but now in the recent quarters, it's growing in the 16% year over year, right? So that is magnificent. Also, that AI integration help company expanding value, right? Some example use was that artificial intelligence within cloud, that is Copilot and draft email and summarize text. As usage grows, both Azure and Microsoft 365 would benefit much from it, right? That is the trend nowadays. So second growth driver will be like the productivity software, which is again the Microsoft 365, which include tools like Word, Excel, Outlook, Teams. So it widely used across the industry, especially the SMEs who prefer familiar tools. And it's growing because it's a software that you use on a daily basis to run your work, right? Business operation. That many companies cannot run their company without these tools. So expectation for the near-term outlook is that short-term constraint. We expect limited capacity earlier this year, we think, because they were reported some supply constraint while their AI demand is still surging. So like they can't really keep up with things, but still the capex, that is why we have huge capex for Microsoft, where they spend most of it on the long-term asset over the last few quarters so they can keep up with the demand. But backed up by the ongoing demand, Microsoft 365, we expect to remain strong, especially with the SME adoption and the AI upgrades, Microsoft Copilot. Lastly, we think Microsoft is well positioned for continued double-digit growth and is to be supported by demand for cloud AI and productivity tools. Lastly, we maintain a positive view on Microsoft with a target price of 480. Yeah, that is all from me. Now, I hand over to Serena. Thank you.
And thank you, Fahmi. Good morning, everyone. So next, I'm going to talk a little bit about digital advertising. So the main theme that we're still going for is that the AI is still is the AI-driven efficiency for the company. So So moving forward for Meta, we still believe that the AI will continue to be the major driver for efficiency, so that they can have a better margin and revenue growth. So after they started to integrate the AI into their products, they do see a higher advertising prices, especially in the US. It's currently growing at 14% year-on-year because of the strong advertiser demand under the better ad performance. So that it can help them to boost their advertising revenue. But we also do see that the worldwide ad prices growth actually slowed down at 10% year-on-year. This is because of the impression growth especially in Asia Pacific region is growing at around 3% year-on-year. I mean, in the last quarter. Regarding to the export, we actually do see the export from China to the US actually dropped quite significantly in April and May. In May, it's around drop of 34%. But at the same time, we also see the export grew in the EU and ASEAN. So we do believe that maybe e-commerce, I mean, the retailer actually started to redirect their ad spending to other markets. So that we actually do expect a higher revenue growth in the next quarter for this region. And at the same time, is that this revenue growth can actually help to offset a little bit of the tariff impact on the US region on a short-term basis. And another silver lining for Meta is that the threads, the monthly active user also grew quite significantly at 130% year-on-year. And WhatsApp business currently has stronger Meta AI usage across all the apps. For Meta, currently they are not monetizing Thread, but they're building momentum on it. They are planning to do so next year. And because WhatsApp business has the stronger Meta AI usage across all apps, it can be an advantage for them to utilize it in order to boost their advertising business in WhatsApp, which they started. They announced they want to start it last month. So moving forward, even though it might not become the major source of revenue, but we do think that the company will start to monetize on this platform so that they will be able to boost their revenue growth. So for Meta, we currently have a accumulate rating with a target price of $720. And for Alphabet, so we do actually see that the advertising revenue growth slowed down from 12%, but it still remain resilient at 10% year-on-year. And the margin, we do see there's an acceleration. That's partly mainly because of Google's actually puts a lot of efforts and in achieving the cost efficiency. And another part is that the cloud business is also becoming another major revenue contribution to the overall growth. So it's currently growing at 28% year-on-year. Moving forward, they will have a partnership with OpenAI, so it's expected to boost the business segment. But the main part of it will be they are expecting in financial year 25 the supply constraint will be eased. So they do see a revenue growth in the cloud business. So with the higher AI revenue, so Alphabet actually expect to have a better AI capability for their advertising services. So currently the cost per click, which is one of the indicators for Google's ad revenue, we do see it fluctuates, but it actually still stays above 6%. This is mainly driven by strong demand from the insurance vertical. So in the short term, the business segment might be slowing down because of the tariff policy, but we do see that advertising business is still a Google primary source of revenue, and we also think that they will still be the dominant leader in search and advertising despite the rising competition from AI-powered search engines such as ChatGPT because of their user base, and at the same time the queries that they process it on an annually basis. Currently, they have like 5 trillion queries annually. That's so for Alphabet, we actually have a buy recommendation, and then with the target price of $250. Yeah. Next, I'll pass the time to Helena.
Thank you, Serena. I'll continue from here. So the next sector we're going to talk about is e-commerce. So with the tariff coming in, definitely it's going to doom the e-commerce sector, which is why we put the title as Calm Before the Storm. Now moving on to the next slide. So I'll be sharing about Amazon. So Amazon definitely is facing the pressure of tariff uncertainties because more than 70% of their products are actually sourced from China. So that makes them in a very vulnerable position. So as the tariff higher, it's going to drive up their sourcing costs. It's going to dampen their consumer demand. So for Amazon, either they have to choose to eat in the increased price and risk losing their margin, or they have to pass the price to the consumers. But we believe in this environment, Amazon can still outperform compared to its other competitors. The reason is two. One is because it has a big scale. It has a very diversified seller base. So that kind of gives it better bargaining power and more flexibility to ship the sourcing to countries that's tariff more favorable, like Vietnam or Mexico. Because they have a variety of different sellers. So some sellers are going to be willing to absorb the price, while others they're going to pass the price to consumers. But there's going to be a more variety, so that kind of buffers the effect. And the second is because Amazon recently they have this strategic focus on shifting to more affordable essentials. So this kind of position it well because it is able to retain price sensible shoppers, even especially in the time of difficulties. So we do expect Amazon to remain a relatively e-commerce outperformer in this macro environment. And if you really look at Amazon nowadays, Amazon, even though we think of it as an e-commerce company, actually it's been slowly shifting to a cloud company. Its cloud sector have been doing really well, like Fahmi just mentioned earlier. For AWS, it's fifth consecutive quarter of growth above 15%. So they're still seeing a very strong demand coming in from the cloud migration. And for the cloud services, we want to see how confident they are. We look at how much they're still investing in their AI. So their capex remain really high. It's going to be around 100 billion US dollar for the entire 2025. That compares to FY24, which is 70.7 billion. So it's still sharply increasing, even though in year 24 it's already very high increase in their capex spending. So yes, they're still doubling down on their AI spend because they're seeing a lot of demand coming in. And for them, they really wanted to make sure that they have the extra capacity when the extra demand coming. So they're not going to risk losing the market share to their competitors. And if we look at AWS operating margin, it's almost reaching 40%, which is way higher than their retail operating margin. So yes, the current macro background is definitely going to shrink their operating margin because AWS is really expanding and pushing the margin up. We do think AWS could cushion the margin decline, at least in the short run. So for the target price, we have 260 US dollar with a buy rating. Moving on to the next sector, which is hardware. Yeah, so hardware is mostly about smartphones. So smartphone, we now seeing a major trend of pretty much all the brands are embracing the AI. They're coming up with new AI functionality. So if we take a look at the global headphone, next slide, please. This is a graph of the global smartphone shipment. So it's pretty much flat, but like the latest quarter, it grew around 5%. So the company that we cover for iPhone would be Apple. So Apple, their iPhone shipment increase for the latest quarter was actually only 2%. So that kind of reflects that Apple is really losing market share. Moving on to the next slide, please. So we're going to share specifically about Apple. So Apple actually held its annual worldwide developer conference earlier this month. This is where their yearly conference where they usually debut their new updates, be it hardware or software. But to our disappointment, this time the upgrade mostly centered around software update, and their biggest highlight was the visual enhancement, which is the liquid glass. It's really just a visual design. So they have very few AI innovations that include the AI translator, which is real life translating. They also have visual intelligence, which is whatever you see on the screen, you can directly check it with ChatGPT. I guess the most interesting one would be they're opening their LLM model to be accessible to third-party developers. But other than that, there's no major news. They're supposed to come out with the upgraded Siri, but they postponed it to 2026 spring. So Apple is really facing two problems for the longest time. The first is its growth is very low, basically flat. Its product sales is always flat. The only good thing about them is their services sector. It's always been growing at double digit and has a very high gross margin. So that is the one that constantly pulling the Apple's gross margin up just slightly because the others drip. So there has been a lot of hype when last year, the WWDC, that is when they introduced their Apple Intelligence for the first time. So that is when people get very hyped up because the latest spike that they had in iPhone was in 2011. So that was like 3 or 4 years ago, which is a reasonable amount of timing where people buy a phone, they own it for 3, 4 years, they might consider buying a new one. And they would be very prompt to do so if there's a lot of new AI functions coming up. So people were really hyped up about that. But up to now, we haven't really seen much splash. The meaningful upgrades are not there, and we still haven't seen any this year's WWDC, which is why we feel even in the next few quarters, it's probably going to remain stagnant just like this. And another problem that they have is they're really losing market share in the China market due to intense competition from the competitors. So the first half of FY25, they lost 7% year on year. And this is not gonna help them out, especially they have the tariff uncertainty and the rising geopolitical friction. Because of that, they have guided that the impact of tariff is going to be around $900 million for the next quarter, and it's going to be even higher in the future quarters because this quarter they probably have some buffer when they try to do some preemptive measures. And they also plan to invest $500 billion over the next 4 years to slowly transfer some of the operation back to their US side. So they're less sensitive for geopolitical frictions in the future. And that is definitely going to increase their cost of production. So we do expect margin compression coming in, and that is not going to help them in the China market where they're already very vulnerable in terms of price competition with the local competitors. And because of these two reasons, we see very limited upside for Apple, which is why we have a target price of $200 with a neutral rating. Okay, moving on to the next slide. So this is just a conclusion. So Magnificent Seven, we see mostly it beat expectation. The growth are very stable, and AI is still the main driver of revenue and margin growth, but we still need a clearer indicator of monetization. We do see a strong recovery at the end of the second quarter, and we expect to continue seeing a strong finish to 2025. So that's all for the US SSP. Now I pass it to Paul to start the Singapore SSP.
Yeah, thanks, Helena. So thanks everyone for joining us morning. We will just go through a summary of the Singapore strategy. So really apologize if those who've already seen it. But what we are going to discuss is basically our strategy. The report will only come out in the next 1 or 2 days because we haven't ended June. But essentially, what we mean by going local is that we see Singapore as where we can get a safe return haven. Because even though if the trade war were to worsen, now Singapore is quite shielded because our tariffs is still 10%, which is the lowest amongst the peers. Number one, of course, the strength of the Singapore currency, the strength of the economy itself. And number 3 is, of course, the cheap valuations and dividend yield. Hopefully, it's no longer be cheap, but that's the current status. So we are still cautious. We still see the trade war issues, but I think we had some questions. Obviously, the market doesn't see that. The market just sees that the market still has the taco view, but we'll go deeper in it when we take the questions. Next slide. Just once, next slide. So just one quick macro outlook before we go to the various, we go to Zane on the technicals. So for us, as you saw the news this morning, there was the One Big Beautiful Bill by the Senate that has approved. So the repercussion of the One Big Beautiful Bill is that the deficit in the US will jump from 6% to 7%. By 2034, the estimates of the interest expense by the US will be from 1 trillion to 1.8 trillion. The estimates can vary, depending how you see the impact on the economy, interest rates. But for us, we also, since everything is beautiful, one big beautiful, so we also going to make one big beautiful prediction. So our one big beautiful prediction is that with the new Fed chair that comes in May of next year, we think the Fed chair will obviously be friendly to Trump. Then what will subsequently happen is that you will get a Fed rate cut. And not only will you get a Fed rate cut, we're also going to get QE. So QE means the Federal Reserve will go into the market and buy government bonds, try to bring down the yields. But there is consequences of all this. Usually, we think the US dollar will collapse. This will also cause inflation. And ultimately, the impact would be the bond market will riot. That means even though interest rates are coming down, but bond yields will keep on rising. Then you get this vicious cycle where bond yields go up, interest expense rise, then the deficit widen again, and until you get that fiscal retreat, whereby the government really has to pull back the spending. We don't have the exact timeline, and this is just a what prediction, and but this is just to give you a framework of what we think one of the direction where the macro environment in the US would be. With that, I'll just hand it over to Zain on his technicals.
Thanks, Paul. I'll move on to the technicals. Next slide, please. So first I'll look at the S&P 500. I guess it's one big beautiful breakout. So it's currently we are at new all-time highs as of Friday. So it's also something interesting is also that this is the fastest recovery to all-time highs after dropping 15% or more in history. So it just took about 90 trading sessions. So I think for this week, we are likely to still see this bullish momentum continue ahead. So going with the trend, and current resistance likely to be at 6,200 to 6,320. And support will likely be around 6,045 to 6,100 area. Next slide, please. Next one, this is a table looking at the forward NASDAQ 100 returns following the last 10 golden cross. So last week, the NASDAQ 100 actually formed a golden cross pattern, which means the 50-day moving average crossed above the 200-day moving average. And this was the first crossover in about slightly more than 2 years. So I think it's a significant move. It usually signals that more returns are to come in the days ahead. So when you look at the last 10 golden cross, last 10 recent golden cross dating back to 2009, these are 1 month to 12-month returns following this signal. So it's very positive. 90% of the time, we do see higher returns going ahead. The 1 month return usually on average is about 4%. 3 months returns is about 9.8%. 6 months about 13%, and 1 year later is usually about 23%. So that's usually a very promising technical signal. Next slide. Next one, we have a technical buy for Warner Bros. Discovery at $11.10. Take profit levels $12.70 as well as $14.50. A stop loss at $10. Last close on Friday was $11.30. So looking in terms of the chart, price broke out of this wedge consolidation in blue in the chart. So we're likely to see some further upside ahead as price has been trading higher highs and higher lows, just steadily trending higher towards this, possibly towards to test these two take profit levels again, with the increasing momentum in MACD as well. Next slide. Next one is we have a technical buy for Reddit at $143.77. Take profit levels at $170 and $190. Stop loss at $122. Last close was $143.01 on Friday. So looking in terms of the chart, price had been consolidating with a key resistance at $126 since middle of March. And recently there was a very significant technical breakout above this level. So I think we are likely to see this continued rebound. Since share price has been coming down since the February highs and consolidating sideways, and now we see a breakout. So we could see some recovery towards these two previous resistance levels. Next slide. Next one, we have a technical buy for Arista Networks at $101.59. Take profit levels $120 as well as $133.50. Stop loss at $91. Last close was $99.39 on Friday. So looking in terms of chart, it had been consolidating sideways between $86 to $99 since start of May. With increasing momentum, MACD is holding above the zero line. With a breakout on Thursday as well, I think we could see some further upside to trend higher towards these two previous resistance levels. Next slide. Next one, we have a technical buy for Amazon at $218. Take profit levels $229 as well as $242. Stop loss at $208. Last close is $223.30 on Friday. So looking in terms of the chart, I think we could see some further upside for Amazon. The price has been holding steady at $206, which was the previous resistance, so holding as support. And we see that there was a period of range consolidation and price broke out above these $218 of increasing momentum MACD as well. So I think we could see a further more legs ahead the rally for Amazon going. Yeah, next slide. So this table actually just summarizes the 4 trades initiated last week. So for Warner Bros. Discovery is up about 1.8% currently. For Reddit is down about 0.5%. Arista Network is down about 2.1%, and for Amazon is up about 2.4%. Next slide. Yep, so this table, it seems like a month end right now. So this table is just to summarize some of the trades, technical calls that were initiated this month. So most of them were thankfully in the green. So for the Russell 2000 ETF is up about 1.6%. For SoFi, SoFi it hit our first take profit level, so it's up about 18.6%. For CATL, we hit TP1 as well, so it's about 6%. United Health still rather sideways, about up slightly 0.2% as of now. Supermicro up about 7.1% for, and the four picks earlier, yeah, I talked about the P&L already. Yeah, so that's generally for our technical calls this month. Next, so the last slide for me, I'll hand over time back to Paul to talk about some of the other recommendations we have on the other sectors. Yeah, thanks.
Yeah, next slide. I think it'll be the banking. So we just start off with the outlook of the Singapore market. So we'll just go through. I think we'll be doing the banks, and our stock picks as well as the REITs, and then we'll be doing the rest as well from the rest of the team. So this is a brief sort of recap of what we went through on Saturday. We'll start off with the banks. DBS, we like it because it's really the only bank with a fixed dividend per share. If you compare it to the other two banks, they do have sort of floating kind of dividend policies, floating, semi-floating. OCBC is a full floating. You get 50% dividend payout ratio with a 10% extra dividend payout ratio for their capital returns. And for UOB, it's a 50% base dividend payout ratio, and then a 50 cents per share per year for their capital returns. Yep. So I think there was this question that I got on which I was unable to answer because of the lack of time on Saturday, and I think it could be a question on many of investors' mind is that why the sudden switch? Because if you remember last quarter, the quarter before, I did I was our picks were OCBC and UOB, and then now I switched to DBS. So the reason for that is before whatever happened with Trump and his tariffs, right? DBS, so UOB and OCBC, we were forecasting for them to have much faster growth because they had expanded into, for UOB they expanded into ASEAN, right, and fee income, and then for OCBC they were also trying to expand greatly into their Bank of Singapore and wealth management. But what's happening now, at least for all across all banks in Singapore, is that whatever excess profits that they have, they will just be placing it back into their allowance coverage, right? And so they will be keeping their earnings flat year on year. I think that's the outlook for the banks. They have alluded to that as much as they could without being so explicit in their earnings call and during the analyst briefings. So all that being said, when everything is flat, when all three banks are just giving the same kind of year on year earnings, flat earnings, right? We like DBS because at least there is some kind of stability where we can see that their dividends will still be paid there, even though earnings might decline slightly, right? And that's the difference. And their dividend payout ratio is also the highest amongst the banks, all three banks, because they are keeping the DPS fixed at $3.05 for 2025. If you can see from this graph here, the blue line, dividend payout ratio, we expect it to even surpass, I think it'll reach around just below 80% for 2025, and they will continue to pay in 2026, so it could possibly go up to even above 80%. And DBS is comfortable to go a bit above that. They say that they have the capacity and capability to do so. They have already set aside the capital, the excess capital, and they also have very huge sums of allowance coverage, right? In brief, all three banks have actually set aside allowance coverage from COVID times, where they really piled on a lot of provisions, and they haven't really spent much of it because the situation then wasn't as dire as it was, as they thought that it would be, but they haven't released much of it. So they let go a bit, but a lot of it is still being held back. DBS is really the only one that mentioned how much they have in management overlay. It was around 2.3 billion, and then this quarter they added on more, so did the other banks, and now it's currently around 2.5 billion just for DBS in terms of their coverage. So the other banks we believe is should be around there somewhere. Yeah, so we believe that there's this huge sum of allowances that they already have in store, so they can continue to give out, and they have already said that they will continue to give out. So that's the reason why we do like DBS over the other two banks. We have an accumulate with a target price of $46.90. So moving on to the next slide. Yeah, it's not that we don't, I guess, like the other two banks, but we do like them for different reasons now. Firstly, for OCBC, our view is that they have the highest CET1 ratio, and in that means that they have the highest excess capitals. The reason for that is because they haven't really spent a lot of money on acquisitions. If you look at DBS and UOB, they have paid a lot for the Citibank assets, right, in ASEAN as well as in Taiwan for DBS. So the upside for that is that we could continue to see them actually continuing this special dividend that they have announced for their capital returns, right, in order to get it down to the optimal level of 14% for the CET1. So we believe, and done some calculations that they will be able to continue this for at least 2 more additional years past what they have already promised. But of course, this is really dependent on the whole macroeconomic situation and whether or not they feel that they have enough in store to continue paying that. But that's the main upside for OCBC. For UOB, it's really the expansion into the ASEAN market, from their Citibank assets. They acquired 4 of them into the Asian 4, they call it, ASEAN 4, sorry. And this has accelerated their growth in these areas by around 3 to 5 years. If you are a frequent visitor to JB, right, or even Malaysia, you realize that a lot of the locals there, they don't have any more Citibank cards, and it's all switched to UOB. And so UOB is a rather large player now in JB and in Malaysia, right? And it's similar in the other 3 ASEAN countries that they have acquired the Citi assets in. So this has really grown their customer base, and also they're moving towards more of a fee income kind of structure. Moving away from the typical traditional SME bank that they are quite known for, into other avenues as well, like card and credit card income, wealth management. So that's what they are moving towards. But I guess for now, UOB is a bit hampered, because they are taking a lot of their excess profits and then putting it into allowance coverage. So that's why the earnings will be quite flat for UOB moving forward. And last but not least, we have SGX. So SGX is benefits greatly from the heightened volatility. We have seen trading volumes, increase by double digits, by more than double digits, in the recent few months, and that's really coming from all the uncertainty around Trump. So that's very beneficial for SGX because they earn from, if they get higher trading volumes, then their earnings will increase as well, right? And apart from that, they also benefit because Singapore has a very strong standing as this flight to safety venue, so it will also further increase volumes for SGX. But then again, it's also very heavily dependent on the volatility. If volatility is higher, then trading volumes will be higher for SGX. Yeah, so we also like SGX for that. So that's all for the finance and finance sector recommendations. I'll now hand it over to Darren, who will touch on the REITs. Thanks.
Yeah, thanks, Glenn. Yeah, so I'll run through some of our REITs topics. So first of all, we have Stoneweg Group Stapled Trust. So excuse me. So as you all know, they just have a new sponsor. Previously was Cromwell European REIT, and previously was Stoneweg European REIT. So now, since they stapled the business trust REIT, it's now known as Stoneweg Europe Stapled Trust. So for them, you see, first of all, touch on occupancy it seems occupancy dipped slightly, but that's because they did some releasing, and as a result, resulted in a lot of very high positive rent reversions in the second quarter. So we're expecting very solid rent reversion numbers in the second quarter. And other than that, the dip in occupancy we think is mostly transitory, so it will pick back up over the next few quarters. So we are looking at about closer to 95%. So that's for the chart. Other than that, they recently made an investment in a Stoneweg Icona DC Fund, data center fund, which comprises of 4 very early stage data center developments. So the impact to DPU from this investment is basically nothing, no impact. It doesn't contribute anything yet. Basically, once the data center is built up, and over the next couple of years, we do expect this 50 million to return like 2-3 times over the next couple of years as the data center is built. Yeah, so we are expecting a lot of NAV uplift for that. And also for Stonemex Europe Stapled Trust, we are expecting some very good portfolio valuation uplift this mid-year portfolio valuations from cap rate compression from lower interest rates like ECB cut rates, and as well as better operating performance, especially for the office portfolio. We've seen previously over the past few valuation cycles, the logistics assets already saw some valuation increases, but this time around we're expecting office to see some increases as well from the higher rent from the leases signed at higher rents. Yeah, so Stonemex paying a very solid 8.7% dividend yield, which is also one of the reasons why I really like them. Yeah, next slide, please. Yeah, so next we have First REIT. So our First REIT, we like them because they are paying a high dividend yield of 5.2%, and they have a very stable 4.5% base rent escalation for their Indonesian hospitals, which currently account for about 80% of their portfolio valuation. So they have this very stable base, even though they are hit by a bit of depreciation of the rupiah. So they also have the potential for some very good potential divestment gains on the fact that Siloam, if you recall, they issued a letter of intent to finance the acquisition of all of First REIT's hospitals in Indonesia. So if they do that, it will likely be at above valuation. I mean, it has to be, if not, First REIT shareholders will definitely not approve. So Siloam, they've also secured a $1.1 billion loan. So we think this might be sooner than expected, the completion of this transaction. Yeah, so with that, that is the potential upside from First REIT's share price, and they might use the proceeds also to basically redistribute or perhaps even return some of these divestment gains to shareholders to reward shareholders. So in a case where this doesn't happen, they are still backed by a solid 9.2% yield with the 4.5% base rent escalation. So we think this is why we favor First REIT. Yeah, next slide, please. Yeah, so for CapitaLand Escort Trust, we like them because of their holistic growth from both their balance mix of stable and growth income sources. So in the first quarter, we see the stable income sources, which comprises of like your rental housing, your management contracts with minimum guaranteed income, and your master leases, as well as the student accommodation. So that is all in the stable income, master leases as well. And they benefit from growth income sources when, let's say, RevPAR or travel demand suddenly spike. So that is from the hotel and the contracts that are under management contracts. Yeah, so we see their portfolio RevPAR also is steadily increasing since COVID. So year on year, we still see some increases, even though some of their peers are seeing RevPAR declines. So Class still saw some slight low single-digit increase in the first quarter. And they also have a very strong asset recycling track record. So we see them divesting assets at a very low cap rate and reinvesting these proceeds into higher cap rate assets. So they get this positive spread. And not to mention, they still have 300 million of more than that, actually, that's 330 million of undistributed previous divestment gains. So that will help to benefit them in a case where, in a situation where DPU declines, for instance, they can just use this to top up. They've already guided that they will maintain DPU year on year at least flat this year. So there are some upcoming AEI plans like the Cavendish London. So that is quite a big asset. So when that goes under AEI, there will be an absence of income and some loss of income from that. So the plan is to use this partially use this 300 million that previous divestment gains to top up that DPU to at least maintain it flat year on year. So that brings it to about 7% dividend yield for Class. Yeah, next slide, please. Yeah, so next we move on to to our other stock picks from other sectors as well. So first of all, we initiated Takraw Corp. I think I saw a question there. So I'll just briefly explain or talk about the GemLife IPO. So for the GemLife IPO, basically they are going to IPO with valuation of $1.6 billion Australian dollars. So that the Takraw used to have a 31.7% stake pre-IPO, but with this IPO, their stake will decrease to 16.8%. So that 16.8% stake is valued at about 220 million. And the Takraw's current market cap is about 175 million. So just this pure stake in GemLife is really valued more than their current market cap. So we think that is a value play there. Not to mention that Takraw still has many other different business segments. As you all know, they are a they are basically a mini conglomerate. They operate in so many business segments like beauty, healthcare, fragrance, exclusive distributor to drones. They own some, or rather they invest in some assets in Japan as well. And they also have like espresso machines in Indonesia, in India, the sales. So it's really a mini conglomerate. So just the stake in GemLife alone is really valued more than the market cap, the current market cap. So, but of course, because they are mini conglomerate, they also have to slap a discount, conglomerate discount to them. Yeah, but I still think it's value there. So I'll just run through quickly how GemLife makes money. So GemLife, they make money from home sales. So as you see, in March, they have 1,862 occupied homes already. So the pipeline of assets, with the pipeline of assets and that target, they are looking at about 6,500 units by 2033. So other than this new home sales or other home sales that they benefit, they also receive some recurring side fees from the lease of the land, because GemLife is a land lease operator. So every week they'll receive some side fees. Yeah. So if you calculate that, just based on the current number of 1,862 homes, they'll get about almost 20 million Australian dollars of annual recurring revenue. And if you calculate that, if you account based on 6,500 units by 2033, there will be about 100 million Australian dollars, not including any inflation adjustments, because this actually side fees is inflation adjusted, but basically if you don't account for that, it's really almost 100 million Australian dollars by 2033 annually. So yeah, that's how GemLife they benefit. Rather, that's how they make money, and that will definitely benefit Takraw over the longer term as GemLife continues to expand. Yeah, so Takraw, they're currently paying a 3.5% yield, which we think is relatively attractive as well. And we have a target price of $2.04. Yeah, so that's for Takraw. Moving on to the next slide, please. Yeah, so for property, we favor CDL. So for CDL, that's trading at a 70% discount to RNAV. And with more asset monetizations underway, like the divestment of South Beach, and possibly more divestments in the hospitality sector as well. So we're expecting the gap to, or rather discount NAV to narrow over time. And not to mention the fact that their property segment in Singapore is also doing very well. They have strong take-up rates for property launches. Like we saw the Ori 70%, 90% taken up already. And their other developments also continue to sell well. So that is for CDL. For CLI also, even though they're not really a property developer, but they're performing very well, especially in terms of the fee income growth. So right now the FUM is at 117 billion. It grew by almost 20 billion year on year from the acquisition of SSP and Wingate. Yeah, and for them, they are executing their asset-light strategy where they're reducing the balance sheet stake. Like for instance, some of the assets in China, they're trying to divest that and put them into some of the funds that they manage. So that again will help to increase the income streams and recurring revenue stream for CLI. So we like CLI. And for PropNext, they are the largest property agency in Singapore. So with the 160% year-on-year surge in new home sales, like we saw year to date, May is really 4,500 sales, excluding ECs. Last year, for the full year, it was 6,500. So there is a surge, and there are many new launches coming up as well. So they will benefit PropNext. And PropNext is trading at 6% yield, and they also have a 60% market share. So they are a market leader. Yes. Excuse me. So that's all for me. I don't have time now to meow. Thanks.
Yeah, thanks, Darren. So we like Elite UK REIT mainly for the attractive and very stable dividend yield of 10%, since 99% of the income is generated from the UK government tenant. And they are a UK office REIT with more than 140 properties and occupancy rate of around 93%, which is expected to maintain at least at this level till 2028, meaning unit holder is able to enjoy a high dividend yield of 10% till then. And the graph is priced to NAV and now is trading at more around 30% to its net asset value, which we believe is pretty attractive. And upside is anticipated to come from its divestment plan. There's roughly 33 million worth of the mature asset to be sold in FY25, which is around 8% of the net of their portfolio value. Yeah, so with the good track record, we believe they are able to divest at a price above its valuation. And Bank of England just cut its benchmark rate by 25 basis points in April. So we believe this will help to strengthen the valuation as well as to stimulate the transaction market in UK. Assuming all the proceeds will be used to pay down the debt, gearing will drop to below 40%. Yeah, next slide, please. And for CMC, the graph is gold price and their share price performance. It has a pretty positive correlation historically, especially like this year. And instead of buying gold directly, we believe CMC is a leveraged play since it has already ramped up its capacity by 60%. Therefore, we expect gold production to increase by 20% year-on-year in FY25. And the new facility not only boosts capacity this year, but will also increase our production further in FY26 with the introduction of the second underground mining facility. So not only ore itself, but also other byproducts such as lead, silver, and zinc. This is supported by the improved ore quality. So we expect production for the byproducts to increase at least by 50% year-on-year in this financial year. And our gold price has increased more than 30%, around 30% year to date, surpassed $3.3 thousand per ounce. And the market remained bullish on gold price in the middle of the highlighted geopolitical tension and also very aggressive central bank purchases. And therefore, CMC stand as the key beneficiary since they sell gold at the spot rate. So we expect average selling price to increase by around 26% year-on-year to $3,100 per ounce. And last but not least, the CMC has a dividend policy of paying out at least 30% of its PATMI, and they tend to increase the payout ratio in a year of strong financial performance. So we believe they'll at least pay out 40%, which translates to around 5.5% dividend yield. Yeah, next slide, please. Moving on to the last small cap we have, which is Zixing. This is a Chinese sweet potato operator. And the graph is their PATMI performance. We like Zixing mainly because we believe PATMI will increase at least by 40% this year, since Chinese government is industrialized the entire sector. So a few catalysts to drive the PATMI growth. Firstly is fresh sweet potato. We expect sales to increase at least by 30% year-on-year, driven by the expansion of their cultivation area and 20% increase in cold storage capacity. And for the processed sweet potato, the new factory is already in place and boosted capacity by 60%. And they're also introducing higher margin functional products like sweet potato powder with margin around 20% higher than the conventional stacks. And they have been actively introducing additional revenue stream like animal feed, which kicking from fourth quarter last year. And since Zixing is outsourcing the collection and production to third party, we believe they will contribute by around 900,000 for net profit in FY26. A long-term catalyst is expected to come from its Hainan rejuvenation project, with total cultivatable area roughly 5 times larger than the current one in Liancheng. We believe PATMI would at least double upon successful completion of the project, and the actual cash flow will start to flow in from FY27 onwards. Yeah, next slide, please. Yeah, so here's 3 stocks that is under our air transportation coverage. We have a reduced call for SIA mainly because of the yield and margin is under pressure with the increasing competition, intensified competition among Asian airlines as they have been ramping up capacity aggressively post-COVID. And the recent geopolitical tension imposed more of the secondary impact, such as consumer sentiments on SIA. And for sets, share price is likely to be volatile since they will be pretty much impacted by all the news related to the US trade war. And even though China and the US reach a consensus to reduce the bilateral tariff, uncertainty still persists on the air cargo segment, especially following the cancellation of the de minimis exemption. And US e-commerce from US to China roughly make up to around 5% of the group's revenue. However, leveraging on the extensive global network, SES is able to make up the loss in demand from China to US routes by demand from other routes like China to Europe, China to Middle East. And lastly, we have a buy call for CAO, mainly because international air traffic increased by around 31% year to date in May 25. Thus, we expect profit from associates, which is Shanghai Pudong International Airport, to increase by around 12% year on year in this financial year. Yeah, that's all for me. I'll hand over to Eben for construction sector. Thank you.
Thanks, Mel. Yep, I only have one slide for our coverage in the construction sector. Firstly, for BRC Asia, for those who are unsure, they are a provider of steel rebar in the construction sector. So for BRC Asia itself, we do see an increased steel volume because of the heightened construction activities. So we do think that this increased steel volume will be able to offset the drop in steel rebar prices for the past few months. And because they have a 65% market share in steel rebar in Singapore itself, we do think that the increased construction progress going forward will be able to benefit them very, very much. And similar story for Pan United. They are a supplier of ready-mix concrete in the construction industry. So for Pan United itself, we also see an increase in ready-mix concrete demand and hence volume for Pan United itself. For ready-mix concrete prices, it has been remaining steady over the past few months. So there is not much of a concern. And because Pan United has a large market share of 40% in ready-mix concrete, we do think that they will also benefit from the increased construction activities as well. For Centurion, for those who are unsure, they are a provider of worker accommodations and student accommodations across the different countries. For example, worker accommodations, they provide it in Singapore and Malaysia. For student accommodations, they provide it in Australia and UK. So for the past few months, there has been a shortage of beds for both worker accommodations and student accommodations, and they have been experiencing higher rental reversions as a result. And going forward, we do think that the shortage still persists. For example, for worker accommodations itself, from the latest MOM data, there has been an increase in migrant worker demand, even though from the start, in January 2024 itself, there has been an introduction of the dependency ratio ceiling, which caps the ratio of foreign worker compared to local worker in the construction firms. But by the end of 2024 December, based on the December data itself, there has still been an increase in migrant worker demand. So this has we do think that this trend will continue with the heightened construction activities. And recently, Centurion's share price has been driven by the potential REIT spin-off announcements. Recently, they announced that they submitted their filings to SGX and MAS for the REIT spin-off. We do think that if everything goes smoothly, this can happen by the end of this year itself, and this will likely drive the share price even higher because they have announced the potential dividend in specie for shareholders. So this means that shareholders may likely get benefits in the form of maybe shares, maybe additional shares as a result. Yeah. For WeHer wise, uh, recently they have sold their Australia student accommodations, but they have in excess right now $232 million in assets potentially for sale. This is about more than half of their market cap. And even though we don't think that the sale will come in this year itself, we do think that for 2026 and 2027, there's potentially even more sale of assets coming up. And WeHer is currently trading at about 36% discount to NAV per share. And this is attractive to us because for their close peers, for Centurion itself, Centurion is trading at a premium to their NAV per share. So we do think that WeHer is still undervalued. And this year itself, WeHer will have a 65% increase in worker dorms because Pioneer Lodge is coming up. So Pioneer Lodge is their new worker accommodations with about 10,000 beds. And we believe that this will further boost their revenue and PATMI. And they also announced $439 million in HDB BTO contracts. So this will likely boost their construction segment all the way to 2029 because the contracts will last till then. As for SoyBuild itself, they are a contractor in the mainly focused in the private sector. So a lot of their orders come from industrial buildings and also those kind of high spec warehouses whereby they need like a high floor to ceiling height. Yeah, so they specialize in those kind of contracts. Recently, we do see an uptick in industrial awards coming up. And for the second half of this year itself, we do think that SoyBuild will continue to bid for those orders, and there's very high chance that they are able to win additional tenders because of their specialty in BIM modeling, which is a video rendering kind of capability they have to create a video of the ideal result from the construction itself, as compared to other players who are still providing artistic impressions to the tenderers itself. So this kind of video rendering will be able to help them stand out as compared to the other competitors. And they are also very specialized in sustainability and green practices, which the private firms have a huge emphasis on, especially those that have net carbon zero kind of requirements. Yeah, so we are still positive on SoyBuild construction until the end of the year and beyond as well. Yeah, so that's all from my end. I'll hand over the time now to Paul. Thanks.
Yeah. Oh, is it you? Thanks, Iqbal. I'll just have a quick run through of the telco sector, some of our recommendations. So for Netlink, I think nothing changes for Netlink. The next few years, I'll probably say the same thing. So they're going to pay a 6% stable yield. And I think there's a bit of shortfall in terms of the ability to pay because they're having quite a heavy capex. But any shortfall will just be offset by higher gearing because they got this lumpy capex they're going to do right now. I mean, if there are more questions, I'll run through it. For Singtel, it's still positive. I think there's still some upside because of Bharti. I think like we highlighted most of the because Bharti's shares is still rallying. I think it hit the all-time high. So just for those who may not know, Singtel owns like 28% plus or 28.6% in Bharti Airtel, the largest mobile operator in India. The share price has run because of the valuation. At one time, it was almost equivalent to the whole of Singtel market cap. And you get a dual benefit when Bharti Airtel share price. Of course, the valuation, all the analysts will raise their target price because we were marked to market with a bit of discount. And the second thing is that Singtel has made it very well known that they will slowly monetize their holdings in Bharti. I think there's another 2 to 3 percentage points worth of to be sold. Okay, and of course, for Singtel, the other thing is the asset monetization. Apart from Bati, they could sell the Gulf development stake that they have. For StarHub, we are a bit cautious because there remains a hyper competition, mobile competition. Every selling prices continue to drop. I think the last time was 5%, quarter on quarter, if I'm not mistaken. This stock is ultimately just waiting a consolidation with M1. And of course, the timing you will never know. I mean, they have a common parent. It's not decided by me, probably decided by the common parent. But we think the biggest winner will be Keppel that has a stake in M1 if they do sell it. Next slide. So for healthcare, Raffles accumulate. I think the recent news that you saw on Mount E, whereby the pre-authorization letter no longer available if you're a Great Eastern customer, could actually will definitely impact clients. I mean, because you were never sure whether you can get your medical insurance fully reimbursed. So and because Raffles they do actually sell their own insurance, so I think they could be better shielded from this. And they continue the background gradual improvement in China. And if you play the long game, I think their valuations are attractive. Why we say long game is eventually if they do sell it, there'll probably be a lot of people queuing to take this company. They're trading, I think right now maybe like 20 times or high teens compared to private market transactions can be as high as 50 times. For K&M, we still have a buy. Of course, the target price is exceeded. We will reevaluate our target price once the results will come out. I think the results, what you could see is a margin expansion because they are still undertaking cost controls. They are refreshing the number of dentists. I mean, you can call it refresh, you can call it removing or keeping the more profitable dentists. And also, they're also doing a lot of cost cutting at their end. And increasing revenue intensity as they use the AI to kind of not push clients to let clients know why they need more complex surgeries. The third thing for them is that as you all saw, the government is raising subsidies on if you do I think root canal capping and all that. So this will also benefit them, and they might want to do some more consolidation or M&A. For Thomson Medical, is a bit more neutral. They are experiencing what the Great Eastern, the pre-authorization letter in Malaysia, but that was last year. So they also face the same thing with GE, but I think from what we understand, but right now the other insurers, but I think they should slowly get these insurers back once there's negotiations. For the Thomson Medical Hospital that we all know in Singapore, that is doing well because they're adding more and more oncologists and they're raising their revenue intensity. Revenue intensity means that the revenue per patient is higher there. Johor is progressing well, so if you're bullish on the whole SEZ in Johor, then they are the big winner because they have the hospital to be built and they have, I think, 10 acres or 9 to 10 acres of land to sell, which they don't need for the hospital. Next slide. Let me move on. There's 2 more slides for me. For Keppel, I think we still like Keppel. I think it's for among the large cap, this is our top my preferred pick because we do see earnings returning, and the earnings returning is it's much more visible because you have the Keppel South Bay, which they was under construction and now is 50% rented or more. So this will be from 0 last year to this year, you're going to get the contribution. Then, of course, by the end of this year, they're going to get the new power plant completed, the 600 megawatt Keppel Merlimau. I hope I get the name right. And the third one is the Bifrost cable, which will be completed this year, will also contribute operation and maintenance revenue. So all this you can see the visible earnings growth, and of course, in the background, they still have a monetization plan. Of course, you will never be clear what are the items. It could be M1, it could be the most important would be the REIT code of 4 billion. And in the background of Keppel, they are building the fund management franchise, which I think the market hasn't really fully revalued that yet until I guess maybe they get larger scale. Semcon Industries we also like it. But of course, we still prefer Keppel because of the visible earnings. Because Sembcorp's new capacity only come in 2027, but Keppel is 2026, the contribution. But you will still see, because they raised their stake in Senoko, power, and they will the India capacity jump almost 40%. The earnings will come in this year, and they're raising their payout ratio, we think, from 40 to 50%. ST Engineering is ultimately just the whole arms race globally, and even if the earnings isn't that strong, I think the whole increase in their valuations of PE right now is almost 30 times, but I think it can hold because of the whole thematic around more and more defense spending. Next slide. So just one last one. So Geo is a thermal coal producer. The share price was down, I think, 10% plus this month. Mainly because of a bit of too much inventory in China, and the coal price also dropped. But we still like it. We think there's going to be production growth, as the title suggests. And because of the new road, the existing road they have is this yellow one, very old, and the capacity. But they're going to build a new 150 million road to be constructed by the state-owned Chinese contractor. I just slipped my mind that name. Yeah, I think it's CCCC. But with this completion, their production will jump from right now maybe 10-11 million to 25 million. And you get a second cut of the earnings because there's another 25 million capacity that can be used on the road to collect toll from other mine operators in the region. But before that, they could even sell a stake in this road operator. So there is a few ways to benefit from this road. Right now, I think it's about 24-25% completed. Next slide. So sorry for this long session. We usually don't, not so long, but anyway, in conclusion, we think the trade war is still a risk, but I think the market is just looking past this. I mean, the whole US market, you can see just doing the taco trade that the trade war won't, even though there was news on this Canada tariffs, but I think the market is just looking past it. But for us, we still like Singapore because regardless the outcome, they will still have the lowest tariffs, resilient valuation. We see that there might be an economic shock from the tariffs, but not recession. And I think these are the favorite. I think we can move on to Q&A. I see there's quite a lot here. Thanks everyone for listening to us.
Yeah, maybe just let me take a few questions first before I hand it over to the rest of my colleagues. Yeah. Okay, there's one here, any downside from the 9 July tariff pause deadline next week. Yeah, with Trump, it can be anything. It can be a downside, upside, really, it's really, really hard to tell. But if you listen into to the US strategy on Saturday, I did say that it seems like Trump is he does use the market performance as sort of his KPI, right? If he goes up, it's good. It means that he's doing well. If he goes down, it means that he's not doing a good job. So it could be possible that he realized that with whatever tariffs he's doing, it did go down. The market was quite negative, and then he reversed it. Hence the phrase, the taco phrase, right, for Trump. So it's a possibility that we could see some release, right, for those countries that have decided to have talks with him, right? We could see improvement on those countries. I think the main one that everyone will be watching on would be the relations with him and with US and China, right? Because that is what is really the biggest sort of like biggest one, right? The biggest part of the whole tariff trade war, right, is him and China. So any downside? Yeah, to answer your question, of course, there could be a downside. If the talks break down, right, he will just retaliate and put back more tariffs again. So of course there will be a downside to that. But I think the upside is that he releases some of the tariffs or even most of them, and just keeps on a feel that he believes the countries are not friendly towards the US. Yeah, so that is the main. I hope I answered that question. Yeah, would there be a recording? Yes, it should be. It will be uploaded to our YouTube channel soon. Yeah. BY. Yeah. Thanks. Yeah, for the US banks, right? I asked ESLR and Fed stress test cleared by the days ahead for US banks. Will they increase dividends? I think they will continue to do the share buybacks. Dividends wise, probably they'll just maintain it the same. So it's quite similar to Singapore where they're putting on a lot more provisions than they need, right? To sort of buffer for a much higher increase in non-performing loans. And for the US, they call it charge-offs. So charge-offs were quite a bit lower than whatever provisions that they have set aside. In general, you look at the US banking sectors around, I think above they put on 1.2 billion more than they needed. Right? And this is really just to put on a larger buffer in case anything happens, right? So we could see, I think the main one is not just the ESLR and Fed stress test, but also a lot of the regulations have been released, especially for Wells Fargo, where they have their asset cap lifted. It just gives them a lot more free play. And then I think the other banks will also be lobbying for even more sort of like loosened regulations. So that will be the main upside for the US banks moving forward. Okay, there's just quickly go through. There's one more on sorry, where was that? Let me try to find that question. Yeah, someone asked from now onwards, every Monday webinar, there is you sharing on US markets again. US sharing will stop for some time, only sharing on Singapore market. No, actually, we did not stop the sharing on the US. If you're listening to our webinars, whenever we have a report that we release on the US sector, we will present it on the Monday. Yeah, so if you listen in, we had I think webinar presentations on almost all of the Max 7 companies, as well as regular presentations and sharings on the US banks as well. Yeah, so we do have it just to listen into our Monday webinars. Yeah, so we definitely do both. Just let me quickly look through if there's any more for me. Yeah, I think that's all for me. I'll hand it over to the rest of my colleagues. Thanks.
Thanks, Glenn. I can take on some questions. I think there's a question about CapEx. Do you have any estimates for announced CapEx for AI data in the forthcoming years, and what sort of time horizon? How will these figures translate to revenue growth for NVIDIA, Broadcom, NTT, and D-Series? Yeah, so in terms of hyperscalers CapEx guidance, they only guide to the end of 2025 itself, and the guidance is about 50 to 60% year-on-year growth. So for 2026 itself, we don't really have much clarity, but Microsoft did say that for 2026 itself, there will still be growth in CapEx, just that the growth rate will be lesser as compared to 2025. Yeah, so the growth rate may slow for hyperscalers, but we do think that in terms of growth in the entire sector itself, it will mainly come from sovereign AI investments, especially like countries like France and Germany as well as Saudi Arabia and UAE. They have been announcing quite a lot of investments into advanced AI chips as well as data centers. Yeah, so we also do think that growth will come from there. And in terms of revenue growth figures, I cover NVIDIA, so I think that for NVIDIA wise, a 40 to 50% growth rate for them over the next few quarters is easily achievable. For Broadcom wise, I don't cover them, so I didn't really look into the figures. Yeah, I'll leave this question here for maybe DC Reads or Darren. Yeah, for next few questions, there's a question on any thoughts on AEM after upward revision of revenue guidance. Yeah, so AEM recently revised their revenue guidance because there's a pull in customer orders, and for those who are not sure, for AEM itself, a big customer for them is Intel, and from Intel's latest earnings itself, they also did mention that their earnings perform better than expected, although it is still flat, but it's better than expected for them because there's a customer pull in anticipation of tariffs itself. Yeah, so this may have flowed downstream to AEM, but I feel that personally this is like a one-off kind of transitory event. After the point itself, whether or not they continue to outperform for the next few quarters, that is hard to say. But Intel currently is still losing market share in the CPU space as well as foundry. Foundry wise, they are not performing as well as TSMC. So we don't have a very positive outlook on AEM. Yeah. There's a question for Centurion. Any revised TP for it? As you called, your last TP is around 1.5. Yeah. So our previous TP is lower than the current share price because the target price is based on the reports being released, and we will release report based on the earnings announcements or if there are material developments in the stock itself. So for Centurion, I think a lot of the run up is based on hype itself because there's a lot of announcements about, I mean, there's some announcements about the REIT spin-off, but we couldn't put a number to it because they haven't provided us with any economic data and financial data about, for example, how many assets they will allocate to the REIT and so on and so forth. So we can't really give a material estimation, and we haven't revised our TP for it yet. Yeah. There's a question. Hi Ben, do you think AMD is a sell into strength now after the run up? Does the AI event justify the current price now, as it's also above your TP? Yeah. So for AMD itself, yes. I think for the TP wise, it's similar to what I explained for Centurion, because we have not written a report to adjust our TP accordingly. But I think I am quite positive in AMD itself because their MI350 chips itself is comparable to NVIDIA's Blackwell GPU chips. In fact, memory performance wise, it has performed better than NVIDIA's Blackwell. Yeah. However, AMD is still it lose out to NVIDIA's entire CUDA ecosystem itself, in which the software developers can troubleshoot and also communicate with each other within the ecosystem itself. So that is still much smaller as compared to NVIDIA. So whether or not it's a sell into strength, I think I'll leave the question to Zane to perform the TA. Yeah. There's a question, is Namly Metal a potential privatization play? Yeah, we don't cover Namly Metal, but I think recently we have seen in the industry we have seen some acquisitions happening. For example, HG Metal, as well as Cosmos Steel, also within the metal fabrication play. I mean metal fabrication industry. Yeah. So I think these acquisitions happen for different reasons. Maybe some of it is to take out competitors, and some of it is to gain their inventory of metals. Yeah. So however, for Namly Metal, I can't really comment much because we don't cover and we don't have much information about it. Yeah. There's a question. Pen United already exceeded your target price. Should I say a downgrade to reduce instead of a buy in your slide? The answer is no. It should not. I don't think my sentiments have changed regarding Pen United. Yeah. So regarding the new target price, we will adjust it after the earnings release. The upcoming earnings release. Yeah. There's a question under the Singapore construction sector. Which two companies will you prefer if you have limited funds now? I think it depends on what you want to invest in. If you want to invest in like a kind of like a higher probability of benefiting from the increase in construction awards being awarded, then I would say that will be building materials. For example, Pen United and BRC Asia, because they have a very large market share in building materials, and all these construction projects, they will definitely need building materials in order to build. So Pen United and BRC Asia will definitely benefit. Yeah. If you want to play into, like, for example, directly into HDB BTO contracts, then I think WeHer has some strength in that, and also WeHer has also a lot of strength in terms of their assets potentially to be monetized for sale. Yeah. So it really depends on what companies you prefer to invest in. Yeah. There's a question pertaining to soy build. Why is there a pickup in industrial building in light of Trump's MAGA when many MNCs will be shifting back to home countries? Yeah, for industrial buildings, there's a few kinds of it. For example, some is semicon data center, some is logistic warehouses. So in terms of semicon data centers, I think we heard from companies' earnings that a lot of those big semicon companies, they think in terms of the time frame of up to 10 to 15 years. So it is not just within this Trump term that because he announced all these MAGA announcements to shift back manufacturing to US, then these semicon companies will just shift straight away, because all these capex investments will last actually for a very long term. So some semicon companies would rather just wait out this term and then just continue to follow their strategy and invest in safer locations. For example, Singapore, because I mean, it is kind of free from natural disasters and also a very ideal geological location for them. I think for logistical warehouses wise, I think EDB has been promoting all these kind of private investments, and they have been working to boost up the private investments in Singapore itself. Yeah, so I think that is what is driving the pickup in industrial buildings. Yeah, there's a question. Hi Ben, since you're bullish on Nvidia for the next few quarters, shouldn't your TP for Nvidia be higher than 145? Yeah, so yeah, as we have mentioned, our TP is based on the reports being published. So if there's a strong, I mean, if there's material developments or if companies release their earnings, then we will release an updated report with adjusted TP. Yeah. Yeah. Yeah, I think that's all for me. Thanks.
Hi, thanks, Ben. So let me take this one question quick. So there's a question on Microsoft, right? You committed accumulate with target price of 480, and then the price jumped to 495. May I know what's your revised recommendation? Thank you. So this report, this target price was released back in April and May, I guess, where we maintained the price of 480. So now it already goes up 485. So for the revised earnings, again, you have to wait for the next earnings call, probably in the late July. I think that we have to look whether their earnings met our expectation or offer and all that, like their performance. But so we have to wait until July. But then again, if you talk about the share price run recently, we looked at Microsoft share price has gone up like 30% after the Liberation Day, right after the stock market sell-off, which is even higher than the S&P 500 sell-off, which is even higher than the S&P 500, 20% plus share price trending upward. So they are increasing higher than the S&P than the market itself. So few reasons of why we think this is because that the market prefer companies such as Microsoft, that it is as a defensive stock, right? Because with the tariff and all would impact mostly companies that are handling physical goods. But Microsoft, the majority of the products are in the software form, right? Because they're selling cloud products and all, right? So, and the physical goods only make about 11% of the total revenue, which is the PC, computing, Windows, and all that. But still, the main growth of Microsoft is actually on its main growth revenue driver is on its software, which is this cloud computing Azure, right? So that's where the magnificent growth is at, right? So we think that where it has been growing at 50% year over year. So we don't think that this will be impacted by the tariff and so on. So that's why I think that people notice this and buy more Microsoft, right? So not to mention, net, we think that we remain positive on the Microsoft. We don't have the revised target yet, but we do think that there's some more potential upside on Microsoft though, that because recently at the previous quarter that they mentioned, there's some supply constraint on the Microsoft to supply the AI and cloud demand. But then again, they also predict that by the second half or more, so after the completion of the data centers and so on, we think that there could be some acceleration on their cloud business though. So we remain positive on this Microsoft because of this reason. Yeah, that's all from me. Thank you.
Yeah, that's really nice.
Yeah, I'll just quickly take the Alphabet question. So, there one is Alphabet. Any reason each price has not been able to move much versus Microsoft and the likes. I think there are two concerns for investor right now. The first one is the very obvious one, which is the impact of the tariffs policy. I think Fahmi mentioned it before. For Microsoft majority, their main service is actually on the software, but then for Alphabet, more than 75% of their total revenue is actually coming from the advertising business. And 50% of it is actually coming from the US. So currently we do see the consumer spending is a bit slow and disposable income is a bit flat. So I do think the online retailers, they need to keep monitor how's the consumer going to react to it before they actually review their spending budget. And the second reason is because of the AI spending of Alphabet. All the hyperscalers are spending a lot of money on CapEx, but Alphabet is like 75 billion, and then compared to Microsoft, it's like 80 billion plus. But Microsoft has a better and more mature AI ecosystem because they actually started to integrate it to all their products. Like Fahmi mentioned, if you saw in Asia, in on 365 Copilot, and then they actually started partnership with OpenAI a few years ago as well. So Alphabet, after spending so much money on CapEx, Alphabet needs to actually justify it, whether there is a ROI on it. I do believe the investor do actually want to see it, because the higher CapEx that they're expecting, it also comes with the higher depreciation, which will actually push a little bit pressure on the valuation. Yeah. So on the short-term basis, I think this is why the reason the prices won't be moved as much as other, such as Microsoft. Thanks. Yeah. I think Darren, you can carry on. Yeah.
Yeah, thanks, Serena. Yeah, let's run through what is your take on NTTI REIT IPO this a decade? Yeah, so for the REIT IPO, we don't have much details because they've also not really met them yet. So you don't have the details, but from what I know is targeted around 7% dividend yield, the price wise, but just looking at the prospectus and the pro forma numbers for FY24, if I'm not wrong, I think I saw the NPIU was only around 5%, so I'm not sure how that's going to work. Yeah, but definitely is a good thing for SGX market, like more options for pure play data centers. Other than right now, there's only Keppel DC and Digital Core, so it's another option for investors as well. But yeah, just note that the portfolio is 4 in US, 1 in Australia, and another in Singapore. So 6 DC assets. Yeah. Yeah, the upcoming Gem Life IPO, what's your take on the possible IPO of Beauty Tech Group for Takraw? Yeah, it is possible. I believe they are looking at it, but no details for now. So I also can't really forecast when this will happen. But it is in the cards, perhaps in the medium term, probably not too soon. Now's the last chance to bought the book before multi-bagger. Yeah, possibly we have a take price of $2.04. Yeah, but like I mentioned, just the Takraw stake in Gem Life is really valued more than the market cap. So there is some value there for Takraw. What's the rationale behind the conglomerate discount for Takraw? Yeah, so for Takraw, because they are basically operating in so many business segments. So that I'll use an analogy, something like a jack of all trades, master of none, something like that, but not exactly master of none. But what I'm trying to say is that they are operating in so many business segments, so they can't really focus on like the best performing ones. They're putting a lot of effort into so many, like even good performing ones and bad performing ones. So that's partially one of the reasons why there's a conglomerate discount. Another reason because with so many business segments, their financials also is not very transparent. And they just commingle everything together. So it's really hard to tell which segment is doing well and not. Another possible reason is for conglomerate discount is that very good performing businesses, like the return from that, they might be used to fund or finance or reinvest into to support the weaker performing businesses as well. So basically that's the reason behind a conglomerate discount for most conglomerates. how does a transport company manage a conglomerate type of business spread? Yeah, so that is why there is conglomerate discount, because they are small, they're operating like a small business in many different business segments. So that is why we do have a conglomerate discount. For us, in fact, we give them a 50% conglomerate discount to the average PE of like other general competitors. So that is how we value the Crown. We will reward existing shareholders with dividend is easy for our coming general IPO. Yeah, so no news on that yet. Yeah, if there are any updates, I will definitely update shareholders or come up with new updates on that. Yeah, but for now, there's no news for that bit. Please comment on Prime US Capital Pacific Oak US target price, dividend yield. Yeah, so for Capital Pacific Oak US you don't cover, so you don't have a target price and a dividend yield. But for Prime US our target price is 20 cents. And our dividend yield is for this year is still about 2% only, because we're forecasting a 10% PR ratio. But from next year onwards, we think things might turn around and it's likely they'll start paying higher PR ratio. So the dividend yield will start increasing from next year onwards. Yeah, so that's our take. But for this year, we don't expect much dividends from Prime, so probably just a 1-2% dividend yield type with a 10% PR ratio. Yeah, I think that's all for me. I have no time to Felix. Thanks.
Yeah, thanks, Aaron. So let me just try to answer some. What's your take on the Infotech IPO? The Infotech IPO, the briefing is only on Wednesday, but let me just share what I hear. So they are essentially a HR software, and I think per license is only a couple of dollars, but they get the benefit because if you install this HR software, you can get some government grants. Probably trading at 18 times PE of 15, but the forward could be hitting 12 times. But anyway, if I think the essential question everyone asking is whether should we subscribe to this. My general view, probably not a fundamental view too, is it's not about subscribing. I don't sure whether you can get enough shares because the public offer is only 5 million, and that 5 million, if I'm not mistaken, is only like 2% of the total float. And because this stock is very well anchored, and locked in, so I think there is a good opportunity for flip. I mean, again, this is my guess, but because the float is so thin and there's so much interest from all the institutions. So that's my own take, although I never really met the company yet. Yeah. This is the non-fundamental guessing view. Any sectors benefit from the Big Beautiful Bill? I think for the Big Beautiful Bill, the one that's going to get hurt is, of course, the EV, electric vehicles. That's the clear one. The beneficiary is going to be a lot of equipment makers in general, largely because one of the game plan of the Big Beautiful Bill is to get investments into the country. So they accelerate depreciation a lot just to make it easier for investors. Capex for manufacturing, capex for oil and gas too, because I think we all know they want everyone to drill in the US, so they're opening more land. So capex is probably the big winner. Because they're giving a lot more tax incentives, so probably maybe the consumer staples might benefit a bit. Yeah. This very broadly speaking, I mean, I don't have the details. I don't really cover US stocks. Yeah. Paul, you previously shared you are more inclined with Keppel rather than Sembcorp. Your comments, please. Not Keppel has high debt than Sembcorp Industries, and revenue for the last 5 years not seem to be growing. Yeah, I think I answered partly that because we think like we mentioned, the earnings growth is going to bounce back for Keppel. And I think faster than Sembcorp because of the new power plants, the submarine cable, and the one whole new building completed for Keppel. So you can imagine they'll just get earnings from them. Any update on Valuetronics, the share price? No particular update, but it's always been cheap, and they're finally getting some traction with their 4 new customers. So Valuetronics is a contract manufacturer. I think the thing is people are maybe putting less risk of the trade war because most of their capacity is all of their capacity is in China and Vietnam. So I think that is why people are pricing out the risk of the trade war or high tariffs out of Vietnam. Hi, Paul. On Saturday, you mentioned M1 Starhub marriage. Curious, what's the impact on Singtel if it does? It will benefit Singtel. Because if they do merge, again, this is just speculation. They do consolidate, then there will be less competition, and Singtel will benefit. But again, this will benefit at the margin from the whole sum of parts of the Singapore operations for Singtel Mobile is probably only 10% plus of our whole target price. So although it's called Singtel, but Singapore Mobile is not a big part of the whole valuation target that we have. Yeah, because most of it is Australia, most of it is Bati, India, Thailand, Indonesia, and so forth. CSE Global, good fundamental stock to invest. Okay, it's definitely a company to invest. So CSE, they are benefiting from, actually, they are one of the beneficiaries if the US undergoes a big capex wave, because they do all the electricity and substation work and so forth. But only thing, again, like we highlighted before, if I want to play the US, I'll just go direct. So that's my only reservation. Yeah. Okay, there's still quite a bit. Will Realma recover? I think not in the near term, because this forfeiture 900 million is still an overhang that they might have to compensate the government, and also until the Chinese consumer recover, then I think that will be another issue for them. Yeah. Why is APAC Realty performing better than Propnex recently? Okay, I never track every day, but I think curiously last Friday, of the 131,000 volume traded for APAC, based on what I saw on SGX, almost all of it was share buyback, which I think is a bit, I wouldn't say dangerous, a bit unusual for a company to be doing all the 100% of the volume. If I'm not mistaken, the volume on Friday was 131,000 shares. So I think the buyback is helping the shares. But again, it's always be a bit wary. The companies cannot actually buy back too much. There's no rule against it, but there are some rules that the SGX frown upon if you are the one buying the shares and also impacting the price. So a bit wary if the company buy too much shares. Okay, I think we probably don't have much time to answer everything. Oh, what's the definition of near-term recovery? I think the next one or two quarters, I think we don't see anything positive for them. Okay, the reason is also sugar has been the big. Sugar did well for Wilmar last year, but this year sugar is down, so they're going to get the year-on-year impact of weaker sugar prices, and consumer is not doing well. So, Wilmar is always three parts. There's the consumer part, because they sell edible oil, they sell food package. Then there's the plantation, the refinery part. That's the second part, and then there is the soybean crushing part. That one I'm not very sure because of the whole tariffs. We're not sure how well they do in timing the purchases. Yeah. So that's why you never get the complete visibility, but I think that is the Food Empire share price rise due to ruble. Yeah, ruble is a big part of it. And also the other part is on the flip side, they benefit because of the lower coffee and the lower sugar price. Yeah. Unlike Wilmar, because Wilmar is the one that's processing sugar, and their margins is also dependent on the sugar price. Okay, I think I'm going to leave it to the technicals. I don't think we can take on all. Sorry for those which we didn't answer. Yeah.
Yeah, thanks for. I'll try to touch on as many TA as I can before we need to close at 1. Yeah, so first up, Q&M. Yeah, so for Q&M, I think it's still a bullish trend still in place. We might see some consolidation in the near term. 46 cents. There could be some resistance for that. The next one probably at 49 cents. But in terms of the trend, I think it's still very bullish. Yeah, so I think probably some consolidation, then it could continue the uptrend. Next one is Hong Kong Land. Another one, I think that's still very bullish. As of now, yeah, you see the pullbacks are being bought up. So still making higher high. I think 580 here, there might be some resistance, but I think then it could still trend higher, maybe towards 6 or 15. yeah, as time goes. So I think the uptrend is still very much intact. Next one for Hobby Land, actually this counter not much volume. You can see sometimes the search is over 1 million volume, then some days don't even have 100,000 volume. So in terms of TA, might not be that accurate, but it looks like it's holding 195, a bit of a previous resistance, so 195 to $2. This previous resistance holding as a bit of support. I think for now probably a bit of sideways, not much volume coming in, and probably 210 this swing high will hold as a bit of resistance. So I think my guess would be quite sideways for now. Next one is on Thomson Medical. So for Thomson Medical, I think the long-term downtrend is still intact. So it probably is trading within this downtrend channel over here. So some facing resistance 0.044 as of now. I guess support will be 0.040, 0.041. So should be a bit sideways or more towards the downside, unless you can break out the channel here. I think for now should be not much. For Raffles Medical, I think for now it's looks like in a sideways consolidation. So it's probably trading holding support at 95 cents, and resistance probably is around $1 to $1.02 area. So I'm guessing there should be some sideways consolidation continuing on for now first. But yeah. Okay, next one is some US counters, Nvidia, MP Materials, and Celsius. So for Nvidia, new all-time high. So I think as long as can maintain above this $153 previous resistance, I think that's still very bullish. Definitely trading above the short-term moving average. So I think we likely to still see this momentum remain quite strong for now. Yeah, to have higher highs. And for MP Materials has currently pulling back after hitting some resistance around this 36 to 40 area is a bit of resistance area. I think we'll hold for it. So I think for now we're likely to see some pullback in terms of the price. Maybe all the 5 and 10 day moving averages, which it has been trending upwards during the rally. So I think short-term support to look at probably somewhere closer to about $30 in my hold as a bit of a support for a bit of a bounce over there. For Celsius, I think the trend is still quite strong. It's quite trending quite well since the breakout of this range between 33 to 39. Price has been trending smoothly, steadily along the 5 and 10 day moving averages, breaking above this around $44 resistance. So I think we could still see this uptrend continue towards the next resistance that's around 48.60 and maybe 52.20 next. These are the next two levels to. Okay, then next up is on SRT, which is the street ETF. So for SRT, I think it's still a bit sideways. Recently, we've seen a bit the share price increase a bit towards, I think this 75 cents. There might be some short-term resistance over here. Then afterwards, it might do a bit of a sideways consolidation, but starting to look better since recovery above this 72 to 73 cents area. So if this can continue to go as support, there will be more, I think there will be more upside. There could be more upside ahead. Yeah. For next one is Parkway Library. I think this one, this around $4 is the very key support that's still holding. Looks to be still continuing on the sideways consolidation, I guess. Yeah, so I think still maintaining between $4 to $4.25, just moving sideways. And for Stoneweg Trust, so Stoneweg actually, there's the new ticker code SET. So this one is the euro denominated one. So I think for now looks like a range trading between 151 to 160 as of now. Yeah, so probably still holding up in this range. And next one is CLR, is also a REIT ETF. This Lion Philippe S REIT ETF. So for this, yeah, it's quite similar as well. So since the break of this 80 cents level is still looking better, there might be some resistance at 81.5 cents, but I think if it can hold the 80 cents level as support, there could be some further upside hit because they've been consolidating over here for very long, since November last year. Yeah, the next level could be maybe 83.5 cents if you can break above 81.5 cents. Yeah, sorry, in view of time, I'll just cover 3 more questions. I know there's still a lot more in the Q&A. So first one for GSD, the gold SG denominated. For GSD, I think recently gold a bit of the momentum has slowed a bit. So I think in terms of this uptrend channel has come off a bit, but I think we are still likely to see some support close to like $375. And this is a horizontal level support. If you look at some of the longer term moving averages, the green line, okay, so it's below the red line, which is the 50 MA level. It has been almost trending above it, but 100 is close to the 100 MA. So over here, there might be still some support over here, around 375 to 380 about there. I think for the short term wise, it might do some sideways consolidation. For Zixing, some rebound from this 0.029 level. This 0.032, 0.033, I think it should be acting as a bit of resistance in the short term because this was a sideways consolidation, there was a breakdown. So here, likely to be from support to resistance. Yeah, so I think we'll be probably facing some resistance and do a bit of a sideways in the short term. And last one, Franken. Yeah, so for Franken, I think for now it's looking better since there was a range consolidation and last week there was a break above this $1.20 level on a high volume as well. So I think it should be able to maintain above this breakout level as a bit of support. The next, I think it could continue to climb towards the next resistance about close to $1.30 around there as the next level. Yeah, so I think sorry, that's all for the TA questions, but feel free to post any TA queries you have in our Poems 3 community group or in the Poems Telegram group as well. Then I'll take it from there. Sorry for the rush today. Yeah, I'll have a time back to Paul if you need, to conclude.
Yeah, okay, thanks. Thanks, Zain. Yeah, apologize. We still have some questions. We try to do a hard stop at 1 p.m. So thanks for everyone. We do have a community. Can we flash it there? But anyway, we do have a community where if you ask us the questions in P3, we can take. By the way, we also have some webinars coming on. I think it is sorry, I'm just it's a VinFast coming on Wednesday for those who are interested to know more about EVs. Yeah, there's a VinFast webinar on Wednesday. It's open to everyone. With that, thank you everybody for your time and especially for your questions. I hope it was useful and wish to see you. Hope to see you again next week. Thank you everybody and have a wonderful week ahead. Thank you everybody. Bye bye.